So right now you'll see, and this goes back more than half a century, back into the 1960s, at 3.6%, well, what is that, 3.6? It actually went slightly above that after that. So it's actually at the lowest amount of cash now in observed history. And you'll notice that the very low cash positions, which are these ones up in here, if you look at the dotted lines, they correspond pretty closely with the major market tops that have occurred over that period of time. The flip side of this is the arrows down here. This shows very high levels of cash in mutual funds. See the scale here, this is percent. And most of these were very close to major bottoms in stock markets. So at least right now, mutual fund managers don't see much need for holding cash, and that historically has been a bit of a danger. We'll see if it proves to be accurate or not this time around. Page 25 shows a study of the bullishness of stock market newsletters. Some of you may get some of those newsletters. This is sentiment on the S&P 500, and it shows that right now the newsletters are relatively in the neutral. They're in the neutral mode, which doesn't indicate a tremendous move either way. If you did a similar study, there is a similar study, I just included one. The similar study of NASDAQ would show it in the extremely enthusiastic mode, which would be in the negative column for performance. Page 26 shows a measure of puts and calls. This is a measure of highly speculative option traders. And they have, when they're at extremes, they have a pretty reliable history of being wrong. So when they're really optimistic, that's usually a danger for the market. When they're really pessimistic, that's usually a pretty good time to look for a market to rise. And right now they're in the excessive optimism category down here. So this, if you look up in the box again, we're in the low performance box, as most of the sentiment indicators are. Page 27 shows a measure of how speculative trading patterns are right now. When trading volume in NASDAQ stocks, which are typically more speculative than New York Stock Exchange stocks, at least historically. When the trading volume in NASDAQ compared to the trading volume in New York Stock Exchange stocks is high, that usually shows a danger. It shows a very high degree of speculation, which, as is seen in the historical graph here, is somewhat dangerous for market performance. That's the worst performance mode. And one of the more esoteric sentiment studies is on page 28, and that is, how much do we like the president? Well, right now, this graph, which was last week, shows the presidential approval rating at 48%. 48% is just below the median, and actually it's in the most favorable mode for stock market performance. Now, I did hear somewhere in the last day or two that the rating was at 50%, and that was also Gallup. So maybe he's gone right up to the middle line here, and that's still in reasonably bullish territory, as you can see looking at the performance box up above. Page 29 shows the last of our sentiment measures. This is a composite study that evaluates long-term sentiment. So I would distinguish. Most of the other things we've looked at are looking at short to intermediate term sentiment. This looks more at longer term sentiment, and this is currently right in the middle of the neutral zone. So this one doesn't give you an awful lot of insight one direction or the other. Now I want to change direction and take a look at some stock market price patterns. If you go over to page 30, this is from Elliott Wave, and it shows at the top here, this shows roughly the last 4 months of the Dow's price progress. And what Bob Prechter was showing in using, actually it wasn't Prechter, it was somebody else in his organization, was the remarkable similarity in that to the market pattern that led to the 2007 top. Pretty similar. It's a 4-month. That may or may not mean anything at all. There's some interesting parallels, at least. They look fairly similar, but all analogs break down at some point. All of them. But people look at these patterns. It's very interesting because people in the markets look at these patterns, and sometimes if they start to continue to look the way the other one did, they start betting in that direction. So if we start seeing some pullback from in here, people are going to say, boy, that looks like this. And it may accelerate selling, or it may not. It's just one of those things you watch, and it may have some relevance till it breaks down. Page 31 takes a different look at market patterns. This is a composite of 3 different types of cycles. Most of you have heard of these. Most of you know there's a seasonal cycle through the year. Some parts of the year tend to be better, and some parts of the year tend to be worse on average. Certainly not true every year, but on average over 60, 70, 80 years, you see some patterns. Most of you have also heard of the 4-year presidential election cycle. And there are patterns that we've traced out now over 4-year cycles that go back certainly through much of the past century. And then some of you may have heard also of the decennial patterns. And that is what typically happens in years that end in 1, years that end in 2, years that end in 3, and so on. Now, frankly, I can see some logic to the presidential election cycle. I see a little logic to the annual cycle. I don't see much logic in a decennial cycle. But it is interesting. If you look at the summaries, and I have never had anybody do a statistical analysis, I'm sure some other people have done it, but there are some interesting data. Sometimes it is clearly better in one collection of years than in another. Well, in any case, what you see on page 31 is a summary of the 3 cycle patterns averaged together. And when they do these things, they warn you. Trend is more important than level. So the amount of up and down is not terribly important. If there is a relevance here, it is the trend, it is not the level. You'll see the blue line is the average of the 3 patterns, which if you look at it and rule out the zigzags, it should be up early in the year to March, April. It should be down roughly to September, October. It should be up through year end. That would be an average of those 3 cycles. The red line, which is on a different scale, this is a much bigger scale. This is about a 10% difference from top to bottom. This is about a 3.5% difference from top to bottom over here. But you'll see what the red has done, which has been in relative concert with the pattern so far. Could be coincidental. Maybe it's going to follow it. Maybe it isn't. But people look at these things. People pay attention to these things. One rather scary analog is over on page 32. Now, before I go on that, let me just talk about the patterns a little bit more. In recent years, March has been kind of a topping month. It was the top month in year 2000, where we had the huge crash that went from there. In 2002, where we hadn't yet gotten to the bottom, we had a significant rally up into March. It topped in March, and we had a 35% decline from there down to the bottom of the